Hello everyone, this is Judy Kristen. I'm from Beckley Associates, and today I'd like to talk to you about navigating executive compensation. Okay, let's start with tax considerations as your business expands. First of all, let's cover stock incentives, things like stock options, restricted stock units, etc. Stock options are divided in two different kinds, non-qualified stock options and incentive stock options. Non-qualified stock options are taxed as ordinary income at exercise on the difference between the grant price and the exercise price, subject to payroll tax, Social Security, Medicare. ISOs, or incentive stock options, are no tax at grant or exercise if holding period rules. They're taxed as long-term capital gains upon the sale. They may also trigger AMT, or alternative minimum tax, at exercise. Okay, so those are the two stock options. Now, let's talk about restricted stock and RSUs. Restricted stock, if it's awarded, it's taxed as ordinary income when it's vested. Now, there's an 83B election that allows taxation at the grant when those restricted stock shares are granted instead of vesting. That would convert future appreciation into capital gains. Let's talk a little bit about RSUs, or restricted stock units. They're taxed as ordinary income when they vest. There's no 83B election available for those. The next type of executive compensation I like to talk about is deferred compensation. Okay, what do I mean by that? Well, that would be 401k and non-qualified deferred compensation plans. Contributions to 401k defer taxation until they're distributed. An NQDC, non-qualified deferred compensation plan, defers the income but must comply with Section 409A rules to avoid penalties. Distributions are taxed as ordinary income. And then finally, let's talk a little bit about golden parachute payments and equity buyouts. Golden parachute payments are severance or change in control payments that may trigger excise tax if exceeding certain thresholds. Okay, excise tax is 20% on excess parachute payments. And then finally, equity buyouts. Okay, what if another company wants to come in and buy your company? What types of items should we consider here? Okay, a cash buyout. The company or acquirer buys out the executive's equity for a lump sum cash payment. This normally occurs in a merger or acquisition where stock compensation is no longer viable. We also have stock for stock exchange. The executive's equity is exchanged for shares in the acquiring company. Taxation may be deferred if structured as a tax-free reorganization. And then finally, deferred payouts or earnouts. Executives may receive payments over time based on performance metrics or continued employment. Tax treatment depends on whether the payout is structured as deferred compensation or an installment sale. Once again, if you have any questions, you'd like to learn a little more about this information, please give us a call, contact us, Beckley and Associates. You can take advantage of the right strategies to optimize your benefits and reduce tax liabilities. We would love to hear from you. Thanks so much.